What is going on, everybody, and welcome to another episode of The Hot Take. This is where we dive deep into one real estate-related topic. Today's topic is very exciting. We're talking how to save money on accounting and structuring your LLCs properly. I'm your host on BatchTV. My name is Jesse Burrell. This is where we talk everything real estate, wholesale, fix and flip, and everything in between. So today's special guest for the hot take is Michael Velasco. What's going on, brother?
Hey everybody. Yeah, thanks for having me today, man.
Awesome to have you on.
Great to see you.
I got to meet you a while back. You actually own an accounting company or a part owner in one.
Yep.
You know, I love saving money on taxes, so this episode was inevitable.
Yes, absolutely. So my name is Michael Velasco. For those of you who don't know me, I own an accounting firm here in Old Town Scottsdale, and we service and specialize in small business, helping from really small individual sole proprietors up to $10 million, $20 million companies, pretty much all over the country. So, and I really, one of my biggest passions is helping people really save money in their taxes and keep their butt out of trouble with the IRS.
So you specifically, though, you specialize in realtors and wholesalers.
I do. Probably 60% of my client base is working with people in the real estate space.
So let's dive into this hot take. This is something I'm excited about because a lot of people, once you start making money, you need to know how to properly save money.
Yes.
Let's talk about LLC structures.
Yeah. So I think here's the thing with LLCs and when wholesalers in particular, people in the real estate space, they start creating LLCs. I think they don't really know why they're creating them.
Right.
And just because you have an LLC, it could be a partnership, it could be a sole proprietor or a disregarded entity, it could be an S corporation. And so when we're creating these LLCs, we have to really understand what we're doing with them. And so it's important to know, hey, how am I going to be taxed on this?
And that, Lauren, is how taxes work.
That's not fair.
You're learning. Uh-oh. Capital gains tax.
You know, when are my taxes due? When are my tax filings due?
Right.
And so those are some of the things that I think as you're creating your LLCs, you should be asking your tax professional.
Right.
So
for example, let's talk about a new wholesaler. You want to create a sole proprietorship, but what you want to do once you get to an X amount of dollar is you want to create an SCorp. And why you want to do that is because if you just have an LLC and that's where you're operating all your business, you're going to get hit with the self-employment tax.
Yeah.
And that is expensive. I had to experience it my first full year in real estate, and I did pretty well. It cost me additional $16,000 by not properly setting up my LLC. So you want to explain SCorps, explain sole proprietorships, and then that self-employment tax. So we could, that's the meat and potatoes of really what I want to get into.
For sure. So if you're in the wholesale real estate space, it's really important you understand where your income's coming from. If you're wholesaling, and really think of it in two buckets. Okay. If you're wholesaling, that is subject to self-employment tax. So that entity eventually needs to become an S corporation and taxed as an S corporation. If you're holding and flipping, that real estate by definition is passive. Yeah, it's passive income, so it's not subject to self-employment taxes.
Gotcha.
So really two buckets, right? Earned, where really it's
a business.
It's a business, right? S corporation's a business. You're earning the money through wholesale fees. That's gonna be something that you're gonna have to tax as an S corporation. And then again, keep a disregarded entity for all of your flips and your rentals because those aren't subject to self-employment tax.
If you are wholesaling, and correct me if I'm wrong, but I believe to switch to an S corp, you need to be netting for it to make sense. What, $60,000-$70,000?
Yeah, I tend to say 40 to 50 because if you're doing, depending on your reasonable salary, right, it's all about trying to circumvent the 15.3% self-employment tax. So that $50,000, you should really start thinking about taking an S election, and what that means is you're going to fill out a form 2553 with the IRS. Let them know you're going to be taxed as an S corporation, and you can't create an S corporation. This is where a lot of the confusion comes in.
Right.
It's like, I want to start an S corporation.
You elect
an S corporation. Jesse brings up a great point. So you can't go down to your corporation commission and start an S corporation. You have to start an LLC or C corporation. And then the LLC can also be a partnership. Right. And so we should really, in talking about S corporations and partnerships and C corporations, those taxes are due the tax returns are due March 15th. Your personal tax returns are due April 15th. Just remember that. So
on a normal year, no COVID
on a normal,
years.
yeah, no COVID years, yeah, which has been really a challenge in our space for the last couple of years. So it's really important you understand that too, because we have people file every day, or new clients come to us all the time, and they don't even realize they have a partnership.
So, for people that do have partners, I want to talk to you real quick.
Yep.
So me and my partners, we each have S corporations, and we have a holding company. So we have 1, 2, 3 LLC. And each of us own our percentage below, and we're all SCorp.
Yep.
So we take our draws from the main hub, and then from there, we could allocate whatever we want to our SCorp. If one of us wants to pay ourselves more or less, we're allowed to do that. It's our tax strategy, but that's how you want to set up a partnership if you're making real money.
Yeah, that makes a lot of sense. And that's how I have my entity set up as well. So you have that mother SCorp that where you can
holding
hub, and then you could start your partnerships underneath it. And then I always tell anybody that's going to start a partnership, it's like a marriage.
Take that. Right here. Thanks. It's a promise of your love forever together. Beautiful.
Right? Let's have an operating agreement, right?
And actually talk to a lawyer.
Yes.
And make sure that it's fair for both sides. Make sure that you're actually hiring a lawyer that does this and knows all the little intricacies that you're having to do that, because we actually are going through and redoing ours again. But as you grow, you change it and you modify it. Nothing's ever forever.
Yeah, amend it. And in our space, in this wholesale space, when I say ours, it's most of the people watching here, there are little things that just are different about what we do. You know, if you're holding with a partner, you're holding properties. When are you guys going to liquidate? Well, what happens if somebody dies, somebody gets divorced, now you got a new partner and an ex-wife, those types of things you guys got to really work through on your operating agreements. So
yeah, a lot of people don't want to take the time because it's not income producing. But trust me, I've had a failed partnership.
Yep. And
it was not fun. There was a lot of gray area, and gray area leads to arguing.
Yep.
And that's not very fun.
Yeah. It can. That's where. And for those of you who don't, we're in Arizona. Many of the states are passing a requirement, like the Corporation Commission here in Arizona passed a requirement that if you have more than one person on the LLC, you have to have an operating agreement now. And so that just changed the last couple of years because of the litigation that was happening. There's this overwhelming the courts with the litigation,
right?
And so they said, we had to have an operating agreement. So at least the judges can go to the operating agreement and go, hey, this is what you guys agreed to,
right?
So, which is important. And those, that's not necessarily a tax savings thing, but it is something that you're going to save down the road, with litigation.
Or you partner with someone savvy when you're getting started.
Yeah,
you could get hosed.
You need to be really mindful of what's in the operating agreement. And here's the other thing that's important about the operating agreement. This is what I see in partnerships, is it needs to be clearly spelled out what your roles are and what you're doing. Because inevitably in partnerships, one partner feels like they're doing way more than the other, and so just clearly, those are some of my.
But you could define if someone doing specific duties, and if they're not, you could try and get out of that partnership or buy them out. Or it's basically an operating agreement is basically like a marriage contract or a prenup or whatever you want to call it.
Right, and they're in breach of the contract, right? And what are the terms for the breach? When somebody breaches it. So those are the things that you should just be. Oh, it's really great to. It's almost like the courting period in marriage with a partner. You're excited and and then the reality hits you in the face when you guys actually start doing business. So just be mindful of that as you guys start those.
So let's talk about someone is wholesaling, flipping,
Mm-hmm.
They're starting to make some money. They want to start buying rentals. How would you structure rentals? Do you put multiple rentals in one LLC? Do you structure each rental with a separate LLC? I know how I do it. Yeah. I'm curious to see how the tax professional does it.
Well, it's interesting. Attorneys and some CPA firms will advise the client to start an LLC for every single property, which there's a reason why. And that reason is simply monetary, right? They want to make more money off of opening LLCs. I think, you could hold 5-10 properties in an LLC. I think people get overly worried about the litigation. I think if you have a good insurance policy, I think that takes care of all that stuff.
So let me elaborate on that. Why you're saying that is because this is for liability. If you have 10 properties in LLC, someone sues you, they could sue for all of them.
Yes, exactly. So within that entity. Yeah. So and I always go back to, okay, why would somebody want to sue you? And obviously I'm not an attorney, but what things happen when we own properties,
Right.
when we flip properties, all of those things. So we just have to be, we can't be neglectful, obviously. We have to have good insurance policies.
Yep.
If somebody gets bit by a dog, we have an insurance policy. If somebody dies on a property, we have an insurance policy. Those are some of the things. Now, if you're neglectful, that's a whole, if you just want to be a landlord, I mean, you're probably going to get sued. So you probably deserve to be sued. So anyways.
And that's where we could. This is with it. I'll bring an attorney on down the road, but this is where land, family trust, all the different trusts. That's where you could really start protecting yourself.
All those layers
assets.
of protection, which are really important. From a tax strategy, you got to be careful. Start setting up too many LLCs because QuickBooks want their money for every LLC you set up. The bookkeepers want their money. We have a bookkeeping department, and we love it when we have a bunch of. But what's really best for you, I think Jesse does this too, is probably put multiple properties in one LLC, and then until you get 5 or 10, boom, you start a new LLC for holding. I don't know what is it that you do?
We do now. We're doing more building apartments and stuff, so those are obviously going to be separated out.
Yeah.
I have 3 duplexes that are right next to each other. They're all in one LLC.
Yeah.
So I'll do 2, 3, or 4 of my personal stuff, but with my partners, we actually separate it out. So our accountant and bookkeeper do love us because we have quite a few LLCs.
Yeah, and if they're big, if they have multiple doors, I mean, obviously, I think you'd want to stay in one. So if you got an 8-plex or whatever,
right?
I mean,
exactly.
Yeah.
So let's dive into our last little hot take, and let's talk about long-term versus short-term capital gains, and if you could explain that to the general audience.
Yeah, that's obviously one of my favorite topics to cover because. Understanding short-term and long-term capital gains, as you guys are holding properties and flipping properties, it's really important you understand the differences. So short-term is less than 12 months, right? And that's taxed at ordinary income. So whatever your income bracket is, and it's probably going to be top end of your bracket. So if you're 24 or 32%, you're going to be taxed at that rate. Okay. Long-term capital gains change dramatically depending on your income. And if you're married, it's under 80,000. I think you pay 0 in long-term capital gains.
Wow.
So long-term capital gains are anything above 12 or more than 12 months. Okay. So if you're going to hold a property, rental property, we always recommend you hold it for at least a year. And then at that point, you're taxed at long-term capital gains. And those brackets are 15 and 20%, depending on, most of us will fall in the 15%. Jesse falls into the 20%, but most of us will fall into the 15%. And then on your flips, just know you're going to pay short-term capital gains, most likely. Okay. So be prepared for that. The good news is it's in a disregarded entity and there's no self-employment tax. So that's the advantage of it. So really know that, especially if you're even trading stocks, right?
Yep,
if
same thing.
you can hold it for a year, hold it for a year. But really, the capital gains tax rates, the long term, are really low. 15 and 20% are pretty low in comparison to our earned income.
Right. So before we go, give the audience, give the viewership one last gem on tax savings. Let's go.
So let's talk 14-day rule. There is a little section of the IRS code that allows you to rent out your personal property for 14 days tax free. And so there's a couple ways you can do that.
Can you Airbnb it? Airbnb it?
You can Airbnb it. And so $300 a night or whatever and get $3,600 in or so, $4,000 in income free, tax free. Or here's a little tidbit. Take your corporation and rent out your house 12 times a month to do motivational and inspirational and marketing events, and your corporation can cut you a tax-free check. So 14-day rule, guys. Get to know it and use it.
You could do 12 days a month, though?
You could do the 14-day rule. 14 is per year.
Oh,
so one time a month for 12 months is a good starting point. Yeah, that's a starting point, and then add 2 during the year if you wanted to. But you get a total of 14 days tax-free.
So I learned something new every day.
Yeah.
I didn't know that. I knew about the Airbnb, but you could actually charge more if you're renting out your space for something like that.
Sure, you could. I mean, I'd stay within market rate, but at the same time, your company can certainly rent out the home from you. Yeah.
I'm glad I just bought the house I bought because that market rate's not going to be cheap.
Yeah, exactly.
So before we go, how does everybody get a hold of you?
So Provident Accounting Services, providentaccountingservices.com, Provident_accounting. If you're on Instagram right now, watching this on Instagram or YouTube, you can just search Provident Accounting and it should be the first name that pops up. My number is 480-200-2914. feel free to reach out to me and hopefully we can help you. So
Awesome.
Yeah.
Thank you,
Awesome,
brother, for
buddy.
coming on.
Yeah. Thank you, man. Thanks for having me.
Thank you guys again for watching another episode of The Hot Take. Again, I'm your host with BatchTV, Jesse Burrell. Michael, thank you so much for coming on.
It was awesome. It was awesome being here. Thanks for having me.
And until next time, let's get it.